Imagine it is November 29th, 2001. You're a 44-year-old schoolteacher living in Buenos Aires, Argentina. Your name is Maria. You have been teaching mathematics at the same public school for 19 years. Your apartment is in the Palermo neighborhood, 2 blocks from the park where your daughter rides her bicycle on Sunday mornings. You wake early, grade papers at the kitchen table while the coffee brews, and walk to school with a canvas bag on your shoulder. You have worked carefully. You have saved patiently. In your account at Banco de la Nación Argentina, you hold the equivalent of 18,000 US dollars. That is your family's entire financial life, your emergency fund, your daughter's university savings, the deposit you have been quietly building toward a small rental property you believe will carry you through retirement. Your account is denominated in dollars, not pesos. You made sure of that. Argentina has been in recession for a few years. Yes, there has been some anxiety in the newspapers, but your savings are in dollars. You are safe. You are certain of it. 3 days later, everything you just felt is gone. Not stolen, not lost in a market crash, not gambled away, simply locked. On the morning of December 1st, 2001, President Fernando de la Rua signs an emergency decree. Bank withdrawals are capped at $250 per week. Bank accounts are frozen. The policy has a name. People will call it the corralito, the little corral, like a fence around a livestock pen. Except the livestock is your life savings. The ATMs go dark. Lines form around city blocks before sunrise. Some people weep, some rage. Some simply stand there, silent, holding their passbooks, looking at the locked doors and understanding for the first time in their lives that the number on their bank statement is not the same thing as the money they think they have. If you have ever wondered whether this kind of thing can really happen, whether governments can actually lock ordinary people out of their own savings with the stroke of a pen, stay with me. What you are about to hear is not a theory. It is a pattern. It has happened before, in multiple countries, on multiple continents, across multiple decades. And it always begins the same way, and it always catches the same group of people by complete surprise. If you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of the kind of events most people never see coming until it is already too late. Before we go further, there is something important to understand, something that most people are never taught in school, something that every banker knows and almost no ordinary depositor does. And once you understand it, you will never look at your bank account the same way again. When you deposit money into a bank, you no longer legally own that money. You have made a loan to the bank. You have become what financial law calls an unsecured creditor, which simply means you are one of the last people in line if that bank gets into trouble. The money sitting in your account right now is not really your money waiting in a vault. It is a number on a screen, a promise, a claim. And claims can be denied. Numbers on screens can be frozen. Promises can be broken by emergency decree. Banks operate on a system called fractional reserve banking. Fractional reserve means the bank only keeps a fraction, a small piece, of the actual deposits in ready cash at any given moment. The rest has been lent out to mortgage holders, businesses, and governments. This works perfectly when everyone stays calm and withdrawals happen at their normal pace. It is a system built entirely on trust. And trust, as history shows over and over again, has a breaking point. Think of it this way. Imagine a neighborhood grocery store that takes orders from customers and promises to have their groceries ready for pickup. The store only keeps a small amount of inventory on the shelves. It relies on daily deliveries from suppliers to refill what gets taken. Everything runs smoothly as long as customers come in 1 or 2 at a time. But the moment 50 customers show up on the same morning, demanding everything at once, the shelves are bare within an hour. The store cannot fulfill its promises, not because it stole anything, but because the system was never designed for everyone to want everything at the same time. A bank works exactly like that store. A bank run, when large numbers of people all try to withdraw their deposits simultaneously, does not even require the bank to be insolvent. Insolvent means unable to pay its debts. A bank can be technically healthy and still collapse in a matter of days or even hours, simply because the speed of panic outpaces the availability of physical cash. And in the first 72 hours of a collapse, that is exactly what you watch happen, step by step, like a building falling in slow motion. This brings us directly to the first chapter of this story. December 1st, 2001. Buenos Aires, the corralito has just been declared. For ordinary Argentines, the first 24 hours feel almost unreal. The decree came on a Saturday. Banks were already closed for the weekend, so there was nothing to do except read the news and feel the fear beginning to settle into the stomach. People called relatives. People argued at kitchen tables. People drove to ATMs and found them running low. By Sunday evening, the machines in many neighborhoods were empty. On Monday morning, the bank doors opened, but only barely. Tellers were authorized to hand out no more than 250 pesos, or $250 per week. For most families, That covered groceries and little else. And here is the first thing most people do not know about Argentina 2001. The accounts that were denominated in dollars, the accounts that people had specifically chosen because they wanted their savings protected from devaluation of the local currency, those dollar accounts were not safe either. In January 2002, the government issued what economists call an asymmetric pacification. Pacification means forcing dollar-denominated accounts to be converted into pesos. Asymmetric means the conversion rate was different for deposits than it was for debts. Savings were converted at 1 peso per dollar. But the official exchange rate was then moved to $1.40. That one act, done overnight by decree, destroyed approximately 40% of every dollar-denominated savings account in the country. People who thought they were holding dollars went to bed with a certain number and woke up with dramatically less. The worst part? It was completely legal. The government had the power to do it, and they used it. Over the following weeks, violent protests erupted across Buenos Aires. Irate depositors smashed ATM machines with hammers. Supermarkets were looted. The government of President de la Rua collapsed. Argentina went through 5 different presidents in a single month. The country ultimately defaulted on $85 billion of sovereign debt, the largest sovereign default in history at that point. And at the center of all of it, the quiet story that rarely makes the international headlines. Millions of ordinary middle-class families, people who had done everything right, whose savings simply ceased to exist in any useful form. Here is something I want you to think about before we go further. If you had your entire savings in a bank account today and you received a message at midnight saying you could only withdraw $250 per week starting tomorrow morning, what would you do in those first 12 hours? Where would you go? What would you try to pay first? Drop your answer in the comments. Seriously. Because what I am about to show you next is the part of this story that most people never hear. The part that happened not in a struggling developing economy, but in the heart of Europe, in one of the most stable-seeming financial systems in the world. And it changes everything about how you think about the safety of your savings. The date is March 15th, 2013. The place is Cyprus. If you have never thought much about Cyprus, that is precisely the point. Cyprus was a small island nation in the eastern Mediterranean, a member of the European Union, a place with modern banks that advertise themselves as safe, regulated, and European. The island had attracted billions in deposits from across Europe and from Russia in particular. Its banking sector was sophisticated. Its account holders included professionals, retirees, and small business owners who believed, with complete justification they thought, that a European bank account was as safe as it gets. On the evening of March 15th, Cyprus's 2 largest banks, the Bank of Cyprus and Cyprus Popular Bank, also known as Laiki Bank, were abruptly closed. No advance warning for ordinary depositors. The closure was announced to be temporary. But when it comes to financial collapses, temporary has a way of meaning something different from what the word normally means. The initial plan proposed by European financial authorities was breathtaking in its directness. Every account in Cyprus with under 100,000 euros would face a 6.75% levy. That is a fancy word for a tax taken directly from your savings without your permission. Accounts above 100,000 euros would face a 9.9% levy. Within hours, cash machines across Cyprus were emptied as people tried frantically to get their money out before the freeze could be fully implemented. But the initial plan was only the beginning. What emerged over the following 10 days was something that shocked financial observers across the world and set a legal precedent that still stands today. Laiki Bank was shut down entirely. And at the Bank of Cyprus, depositors holding more than 100,000 euros lost 47.5% of their savings above that threshold. Nearly half gone, converted, without their consent, into bank shares of uncertain value. Regulatory authorities confirmed that some depositors could ultimately lose 60% of everything they held above the insured limit. The banks remained closed for approximately 2 weeks. During that time, Cypriot businesses could not make payroll. Suppliers could not get paid. Retirees who depended on accessing their savings found themselves rationed to a few hundred euros in daily cash withdrawals once the banks finally reopened, with strict limits on how much money could be transferred out of the country. The capital controls, the restrictions that prevented money from leaving the system, remained in place in various forms for more than 2 years. Here is what makes Cyprus so important in this story. The bail-in, which means taking money directly from depositors to recapitalize a failing bank, was not illegal. It was not a crime. It was done in full compliance with the legal framework that European financial authorities had put in place. Cyprus was not a rogue state. It was not a dictatorship. It was a democratic European nation. And its government, in cooperation with international financial institutions, took nearly half the savings of large depositors in a matter of days, because the law allowed it, because the crisis demanded it, and because by the time ordinary people understood what was happening, it was already done. Most people will never know what you now know. Most people will keep trusting systems they do not fully understand. Most people assume that because something has not happened to them, it cannot happen at all. If you're still watching, you're not most people. Hit subscribe. Because what is coming next is the part of this story that this channel was built for, the part they never put in textbooks, the part that connects the dots between Buenos Aires and Nicosia and a dozen other cities across modern history, the part that reveals why the first 72 hours are always the same. Now observe what all of these cases have in common so far. In both Argentina and Cyprus, the government did not announce a financial emergency weeks in advance. The freeze did not come with a polite letter in the mail giving you time to prepare. In both cases, it happened over a weekend. Banks were closed on Saturday and Sunday anyway. By the time the Monday morning alarm clocks rang, the rules of the game had already changed. The doors were already shut. Your choices had already been reduced to almost nothing. This leads us to the third chapter. The date is June 28th, 2015, a Sunday evening. The place is Athens, Greece. Greece had been in economic crisis for years, and the newspapers were full of debt negotiations and bailout packages and political drama. People knew it was bad, but most ordinary Greeks believed, as people in these situations almost always believe, that their bank accounts were safe, that whatever happened between politicians and international lenders, their personal savings would be protected. On that Sunday evening, the Greek government announced that banks would close the following day and remain closed for at least a week. Capital controls were imposed immediately. Automated teller machines, ATMs, were limited to 60 euros per day per card. That is roughly $67, not per week, per day, which sounds manageable until you realize that 60 euros does not pay rent, does not cover a month of groceries, does not settle a business invoice, and cannot be used to make an international transfer or purchase anything online from a foreign seller. Credit cards used by Greeks abroad stopped working. Greeks traveling outside the country found themselves stranded without access to funds. The Athens Stock Exchange was closed. And here's a detail that tells you everything about the human reality of these first 72 hours. Some Greek citizens who were in foreign hospitals receiving medical treatment could not access the funds to pay their bills. Some businesses could not pay their suppliers. Some landlords could not collect rent because their tenants literally had no way to transfer money. The capital controls in Greece remained in various forms for over 3 years, finally being fully lifted only in September 2019. 3 years of restricted access to your own money. 3 years of economic life in slow motion. Then there is Lebanon. On October 17th, 2019, nationwide protests erupted over an economic crisis that had been building for years. Within days, banks imposed informal capital controls, restrictions on withdrawing foreign currency, limits of $200 to $300 per week on foreign currency access. Lebanese depositors had billions of dollars of savings in accounts denominated in US dollars, but those dollars became inaccessible. Over the following months, the Lebanese pound lost more than 90% of its value. Students who had been studying abroad could not receive their tuition from their parents' accounts. Families could not pay hospital bills. People who had saved in what they believed was a stable, dollar-denominated account watched those savings become effectively unreachable, then effectively worthless in local purchasing power. At this point, the pattern becomes impossible to ignore, and this is where history gets uncomfortable. Look at Argentina, Cyprus, Greece, and Lebanon together. 4 different countries, 4 different decades, 4 different stated causes: sovereign debt, a banking sector overexposed to risky assets, an international debt negotiation gone wrong, a political and economic governance failure. The stated causes are different in every case. But the sequence, the mechanical sequence of what happened to ordinary people in the first 72 hours, is nearly identical every single time. Here's the sequence. It begins with a rumor, or a news announcement, or a surprise government statement. It almost always arrives on a Friday evening or over a weekend, when markets are closed and authorities can implement changes without the immediate pressure of trading. The first 12 hours see a quiet but accelerating rush. Digital transfers spike. ATM queues begin to form before dawn. The people who move first, who understand what the signals mean, start pulling cash. The next 12 hours see the machines go dry. Physical cash disappears from circulation faster than it can be replenished. Banks begin to enforce informal limits even before official policies are announced. Then comes the official announcement, the freeze, the capital controls, the daily limit. At that moment, the first 72 hours reach their conclusion. The doors are shut. The number on your screen is still there, but the connection between that number and any physical, accessible, usable form of wealth has been severed. The rot is never in the surface. It is always in the beams. Financial collapses do not begin when the announcement is made. They begin months or years earlier in decisions made by governments and banks that most ordinary people never hear about. The announcement is not the beginning of the crisis. It is the moment the crisis becomes visible. By then, it is almost always too late to move. And here is the most counterintuitive fact in this entire history. In nearly every one of these cases, the people who got out, who preserved their savings, did not move when the announcement came. They moved long before. They were paying attention to something most people were ignoring. They understood, on some level, that the system was under stress, and they acted while acting was still possible. Before we look at what those people did, let us be very clear about who paid the price when they did not, because the human cost of these first 72 hours is not evenly distributed, not even close. In Argentina, the people who suffered most were not the poor. The poor had no savings in the formal banking system to begin with, and they were not the very wealthy, the politically connected, or the large institutional investors, many of whom had been moving money offshore for months before the Corralito was announced. The people who were devastated were the middle class, teachers, accountants, small business owners, medical workers, tradespeople, people who had done what society told them to do. Work hard, spend less than you earn, put the rest in the bank. People whose financial behavior was entirely rational and entirely orthodox. They were the ones standing in those lines. They were the ones watching the ATMs run empty. They were the ones whose 40 years of savings got converted to pesos at an exchange rate decided by a government decree signed at 2 a.m. In Cyprus, the same group took the blow. Retirees who had spent decades building savings above the insured threshold. Small business owners who kept operating capital in their business accounts. Professionals who had simply accumulated money over time because they earned more than they spent. These were not speculators. They were not gamblers. They were people who trusted a system that had the legal authority to take their money when the system itself needed to survive. In Greece, the €60 daily limit fell most heavily on those who had no alternative. The people with foreign bank accounts or foreign assets or cash held outside the system, they were inconvenienced. The people for whom that single bank account was all they had, they were trapped. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will recognize it before it recognizes you. If watching this kind of historical analysis helps you think differently about the world you live in, subscribing costs nothing. And the clarity it brings might change the decisions you make long before any crisis arrives. Because the next part of this story is the part that actually matters. Not what happened to the people who got caught, but what was different about the people who did not. The historical record across all of these events reveals a remarkably consistent pattern among those who came through financial collapses with their savings largely intact. It is not glamorous. It is not complicated. But it requires a kind of advance awareness that most people never develop, because most people assume that the systems they live inside are more stable than they actually are. The first thing the historical survivors had in common was that they did not keep all of their liquid wealth inside the banking system. In Argentina, accounts that were not in the formal banking system could not be frozen. Physical cash held at home, whether in pesos or in dollars, remained usable during the Corralito. In Greece, people who had withdrawn cash before the June 28th announcement could keep paying for groceries, rent, and fuel, while their neighbors stood in ATM lines. In Cyprus, business owners who had diversified into foreign bank accounts maintained access to at least some of their liquidity. This is not a recommendation. This is simply what the historical record shows. The people who had no alternative outside the banking system had no options. The people who did had choices. The second characteristic the historical survivors shared was ownership of assets that existed outside the financial paper system. Real property, productive land, a business that generated actual goods or services. In Argentina, after the devaluation, real estate that had been priced in dollars held a different kind of value from a bank deposit. It could not be frozen. It could not be confiscated with a decree. It was still there. In Zimbabwe, where the hyperinflation of 2008 reached 79.6 billion%, a number so large the World Bank stopped tracking it, the people who owned physical productive assets, farmland, tangible inventory, tools, had something to exchange and something to eat. Those who held only bank balances and currency held nothing at all. Estimates suggest Zimbabwe's annual inflation rate exceeded 1 million% as early as May 2008. By November of that same year, the official figure was nearly 80 billion%. At that rate, a price can double in less than a day. Your bank account balance means nothing. The grain you own means everything. The third characteristic is harder to name but shows up clearly across the historical record. The survivors paid attention to early signals. They read the stress in the system before it broke. They noticed the moments when institutions began behaving unusually, when interest rates offered on savings accounts started rising suspiciously fast, as happened in Lebanon before 2019. That was a signal. When a government began restricting transfers or placing informal limits on large withdrawals, as happened in Argentina in the months before December 2001, that was a signal. The pattern always shows signs before it shows itself. The question is whether anyone is watching for them. None of this is financial advice. The historical record does not dictate what any individual should do with their savings. What it does show, with remarkable consistency, is that awareness is the only tool that functions in the window before the freeze. Once the decree is signed, once the ATM queues form, once the bank doors carry that handwritten sign that says closed, the options available to the ordinary depositor narrow to almost nothing. The first 72 hours are not the beginning of the problem. They are the end of the window. Now let us go back to Maria, the teacher in Buenos Aires, standing in line on the morning of December 2nd, 2001, holding a bank passbook in the South American heat. Maria waited in line for 4 hours that first morning and withdrew 250 pesos, the maximum allowed. She went back the next week, and the week after that. For months, she lived on that weekly ration while the government worked through its crisis and the courts fought over the constitutionality of the freeze. In early 2002, when the forced pacification was announced, her $18,000 in savings were converted to pesos at the official rate, and then the peso was devalued. She lost, by one documented estimate from Oxford Research Encyclopedias, approximately 40% of her savings in a single accounting entry, not through any action of her own, not through any mistake, simply through the mechanics of a system exercising its legal authority over her money at a moment of maximum vulnerability. She was not alone. Millions of Argentines lived this story. Many never fully recovered financially. The middle class that had taken 3 decades to build was compressed in months. And in the years that followed, Argentines famously became one of the most cash-holding, bank-skeptical populations on Earth. They built that knowledge the hard way. The lesson of the first 72 hours is this: the systems we trust with our financial lives are not the bedrock we imagine them to be. They are complex, interlocking structures built on confidence. When confidence breaks, for any reason, by any trigger, the sequence that follows is old, it is documented, and it is always faster than any ordinary person expects. The collapse is not a fire. It is a river changing course. You do not see it moving. And then one morning, the ground where you were standing is underwater. History does not repeat exactly, but it rhymes with a precision that should make anyone paying attention take notice. From Buenos Aires in 2001, to Nicosia in 2013, to Athens in 2015, to Beirut in 2019, to Silicon Valley in 2023, where customers withdrew $42 billion from a single bank in a single day, triggering the second largest bank failure in American history. The first 72 hours always look the same. The only variable is whether you already knew what to watch for. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision based on anything discussed in this video. This video is not for everyone. Most people will scroll past it. Most people will continue trusting systems they have never thought to question. But if one person in your life, a parent, a sibling, a close friend, needs to hear this kind of historical clarity, share it with them. Not because it will change the world, because it might change their world. Subscribe for more of this kind of deeply researched economic history, and I will see you in the next one.